Hello, Adam from the Mortgage Hub.
Hello.
I've got a question for you about new build mortgages.
Okay.
Since new builds can get delayed, what happens if your mortgage offer runs out before the house is finished?
So let's just clarify new build. New build is a brand new property, never been lived in before. And as it's the first time you own a property, new build itself, there are different schemes, or if like lenders look at things in a different way than they might do on a standard second-hand or 100-year-old property, basically. So one of the key things with new builds is that the developer, the builder, they're looking for quick to exchange. Now, exchange of contracts is where you are legally obliged to buy the property, and they're usually looking for exchange of contracts within 28 days. So that all the legal work, all of the mortgage work, everything has to be done within 28 days, or the developer threatens to sell it to another, basically to another person who might be able to move a bit faster than you. So mortgage offers, when they come out, mortgage offers are typically valid for 6 months. But on a new build property, there's a lot of lenders that appreciate that just because you've got to legally commit yourself to buying a property, at that stage, it might not actually be built. And the builders might take a little bit longer than the next 6 months to actually finalize and finish the property for you to be able to move in. And so some lenders will offer 12-month offers on their mortgage offers in order for you to be able to have that extra peace of mind that your finance offer is not going to run out before the property is actually built. There are other lenders that still leave it at 6 months, but then they will offer you the option of extending the mortgage offer at that stage. And the offer extension is usually just they'll re-credit check you, okay? Or they might ask for an up-to-date pay slip. So what I would say is, during the process of buying a property, it's really important not to change your circumstances too much. I wouldn't say don't go and find another job if that's the right thing for you to do as a person. But, taking on additional loans and credit cards and going to live the high life, probably not the most sensible thing to do if you're, committing yourself to the biggest financial purchase that you're ever going to make. So yeah, in terms of the mortgage offer expiring, don't worry about that too much. That's our job to do the worrying for you. If you're interested in buying new build, we've got access to the whole of the market. We've got expert advisors that deal with new build on a week by week, month by month basis. So just give us a call on 0121 323 4999 and we'll steer you in the right direction.
Thank you, Adam. Developers often offer freebies like paying your deposit or legal fees. How do banks actually look at these deals?
Freebies is probably not the right word. I'd rather use the word incentives. So we talk about new build incentives. New build incentives can be things like, a dishwasher, some integrated stuff in the kitchen, or it could be carpets, it could be flooring. It could actually be something else financially. It could be stamp duty paid or solicitors' fees paid, or just money towards the deposit, if you like. Now, there are different ways of looking at the incentives. Mortgage lenders do want to know about the incentives. And as long as it's not over the top, they're generally okay. When I say over the top, they're normally looking at sort of around about 5% of the value of the property in terms of the incentives that are provided. And those incentives are then viewed as additional, if you like, your deposit is increased because the purchase price has been reduced. And so we'll look at, what options, what interest rates are available based on the amount of money that you're putting in, the amount of money that is being incentivized, or the value of the incentives that go towards the property, and the value of the property as well, and will determine what interest rate you've got available. There are a handful of lenders that are registered on what we call the Own New scheme, and those incentives, or the finance, the offer that you get from the builder or developer, can actually result in a much lower interest rate on your mortgage, rates as low as 2%, whereas as it stands at the moment, they're sort of typically around about 4 or 5%. So you can, benefit from a reduction in interest rate, a reduction in payment, or we can look at incentives in a slightly different way. So the interest rate stays the same, but we've got an enhanced deposit. At this stage, if you're not sure about what to do or what's best for you, just give us a call. We're happy to help in any way that we can for you. It's free advice that we give. Give us a call on 0121 323 4999.
Thank you, Adam. So I have another question to do with new build mortgages.
Okay.
Do you usually need a much bigger deposit if you're buying a new build flat compared to a house?
Sometimes yes, is the honest answer to that. New build itself, it's brand new, and if we think about a new car scenario, it's probably the best way of me explaining how new build works. You see, when you buy a new house, it's never been owned before, so you're kind of paying a premium for it to be brand new. Nobody's ever had it before. Same happens with a car. You buy a brand new car. Soon as you drive that car off the forecourt, it depreciates in value. It's no longer brand new. It's second hand, and so it's gone down in value straight away. Same happens with a house. You've bought the house, you've lived in it. There are other houses being built. There are that are brand new, so yours immediately potentially decreases in value. Not all the time, but potentially it does decrease in value. That's the worry that the mortgage lenders have got, is if you don't repay them, then they're going to have to repossess your property, sell it onto somebody else, and they don't get their money back. So they usually require a deposit to be put towards a property. A deposit is the amount of money that you're putting into the property. So the difference again between a house and a flat is that a house itself is more of an appreciating asset than potentially a flat might be. Flats are typically leasehold, and a lease itself has an end date to it. So there's an expiry date on a lease. And as you get closer to the end date, it depreciates in value. So a flat potentially will depreciate faster than a house in periods where property prices might not be going up. So the lenders know this, and so they sometimes require a slightly larger deposit on a flat. What I will say is that is not strictly as true as it used to be once upon a time. So, I've been doing mortgages for a long, long time, and once upon a time it was a 15% deposit on a flat and a 10% deposit on a house. I can tell you now there are some lenders out there that will do 95%, so a small deposit on both a house and a flat. Not every lender, but some lenders out there. What we can help with is determining which is going to be the best option for you, what your options are, and help to steer you again in the right direction and make sure that there are minimal problems throughout the whole process. So just give us a call on 0121 323 4999 if you're interested in finding out more.